Welcome to this chapter, double entry bookkeeping. As usual, you can get the book on which these slides are based by following the link on the screen. Today we're going to talk about double entry bookkeeping, and to understand double entry bookkeeping we need to go back to the accounting process and understand what goes on in the accounting process. So accounting begins when you get source documents, so that's your receipt, your invoice, your credit note, your debit note, and all those other documents that you probably come across. The information from these documents is recorded in books known as books of prime entry or books of original entry. The information from the books of original entry is then summarized into ledgers using double entry bookkeeping, which is what we are going to do and practice in this session. The summary of the double entry accounts is then transferred into a trial balance, which is basically a list of transactions and account balance or account balances from the different ledgers. The information from the trial balance is then further summarized into the financial statements that are published externally to the public, which would include your statement of profit or loss, your statement of financial position, your statement of changes in equity, and your statement of cash flows. Let's go through each of those key items one by one. Let's start with source documents. There are several source documents that are used for different purposes. You need to know each of these documents, its content, and the purpose that each of the documents is used for. The key source documents include a quotation, a purchase order, a sales order, a goods dispatch note, a goods receipt note, an invoice, a credit note, debit note, statement, remittance advice, and a receipt. Pause the video and check each of the items and what its purpose is. Information from the source documents is summarized in what are known as books of original entry. The key books of original entry include the cash book, petty cash book, the 4-day books, and the general journal. The cash book records all cash transactions. The petty cash book records all small cash transactions. The sales day book records all sales that were done on credit. The purchases day book records all purchases that were done on credit. The sales returns day book records all sales returns that were done on credit. The purchases returns day book records all purchases that were done on credit. A sale basically means the organization or business for which you are accounting gives its goods or services out in return for cash or for payment later. Purchases is where your organization that you're accounting for receives goods or services in return for cash or payment later. A general journal records all transactions that cannot be shown in any of the other books of original entry. This would include depreciation, correction of errors, and other items that cannot be shown in any of the other ledgers. Here's a summary again of the books of original entry. Please note that the sales day book is sometimes known as the sales journal. The purchases day book is sometimes known as the purchases journal, and so on. The journal is also known as the general journal. Information from the books of prime entry is summarized and transferred into ledgers. Ledgers are kept using double entry bookkeeping. A typical journal would look like this. There's the account name. A typical ledger account would look something like this. There's the account name, there's a debit side, or this side is a debit side, and then there's a credit side. On the debit side you show the date, details, and amount, and on the credit side you also show the date, details, and amount. The debit side is DR for short, and credit side is CR for short. Often accounting is done in thousands, millions, and sometimes billions, and so you may want to summarize by showing the thousands on top. We'll see how this works in the example. When entering amounts in the ledger accounts, you follow what is known as the golden rule of accounting, or double entry rule. And the double entry rule is that you debit the receiver and credit the giver. Let's start with this example to understand how double entry is done. You can pause the video, read the content, and then we'll begin from there. I believe you've taken time to pause and you've read and are ready to do the question. The first part of the question asked us to enter the amounts in the ledgers, and in the second part asked us to balance the ledgers and extract a trial balance. So we'll start with the first transaction, which happened on the 1st of January. The owners invest $10 million cash into the business. According to the double entry rule, there has to be a receiver and a giver. In this case, when the owners introduce cash, it means cash is receiving, and so we create a cash account. And because cash is receiving, we need to debit cash. So on 1st January, because cash capital has been introduced in the form of cash, we debit cash with $10 million. Notice how the 10 million is written as 10,000 with the other thousands on top. So we are done with the cash and we debited cash. In the same vein, we need to credit capital. And so on the 1st of January, we enter cash and we enter 10,000. This completes the double entry for the introduction of capital into the business. So the double entry is debit cash and credit capital. On the 2nd of January, they purchase goods for 4 million and pay using cash. Again, the receiver is purchases because we're increasing our purchases, and the giver is cash because we are losing cash. Therefore, we debit. We enter the debt, and cash is going out of 4 million, so we've debited purchases, and we credit cash. So here we go on the 2nd of January, we enter purchases and we enter 4 million. Notice that we did not open a new cash account but updated the one we already have. We only open a new account if we do not have one, as you will see later. Let's go to the next transaction, which is 3rd January, where they buy a delivery van for 2 million and pay using cash. So here delivery van is supposed to be debited and cash is supposed to be credited. So van, we open a new account because we didn't have a van account. So on the 1st of January, that date is supposed to be 3rd of January actually. So on the 3rd of January, we debit cash of 2 million. We debit van with 2 million and then we credit cash. So that's 3rd of January, van 2 million. We can go to the next transaction, which is on the 4th of January. They purchase 1 million of goods on credit. So here we are increasing our purchases and increasing our creditors. So we go back to the purchases account, which already had amounts, and we say 4th of January. Creditors are also known as trade payables. So trade creditors or trade payables is the same, is one and the same. So we debit purchases because purchases have increased with 1 million, and then we're going to credit trade payables. So we open a new account, call it trade payables on the 4th of January, and so we enter purchases to show where the amount has gone, and we enter the 1 million. Okay, on the 5th of January, we sell goods for 1.5 million kwacha cash, $1.5 million cash. So this is a debit to cash and a credit to sales because we have sold goods on credit. Therefore, we go back to our sales account, to our cash account, and enter 5th January, going to sales 1.5 million, showing that we've received cash due to sales of 1.5 million. And so we go on the sales account and we're going to enter a credit of on 5th January for cash of 1.5. The next transaction is that we sell all remaining goods for $5 million on credit. So again here we're going to credit our sales and we're going to debit our trade receivables. Let's go there. So we have 6th of January, trade receivables 5 million, and we've shown that sales are being credited, and so we go and debit our trade receivables 6th of January, sales of 5 million. Trade receivables are also known as trade debtors. So please do not get confused about trade debtors and trade creditors. Pause, rewind, and check how we treated trade creditors and how we treated trade receivables. Trade receivables are also known as trade debtors. Let's proceed. On the 7th of January, we pay 800,000 to suppliers by cash. So cash is going to be reduced there. So we're going to credit cash and debit those suppliers. So the suppliers are trade payables, so we debit them on 7th of January with cash of $800,000, and we credit cash 7th of January going to trade payables over 800,000. Finally, on the 8th of January, we pay rent of 200,000 cash. So cash is going out, we need to credit cash and debit rent. So when we go back there, we debit rent 8th of January for cash of 200,000, and then we're going to credit cash on the 8th of January of 200,000. That completes the transactions, and we have answered part 1 of the task that we were given. So here's a recap of what we've covered. Remember, the double entry system helps keep the accounting equation to balance. So the accounting equation is that assets equals to equity plus liabilities. We've looked at the accounting process. You need to learn the steps. We looked at the books of prime entry. There were 7 books of prime entry. We've looked at ledger accounts or ledgers. There are 7 ledgers. We've looked at the double entry bookkeeping and the golden rule of accounting. Do practice a lot of questions to understand what goes on, and you can see some of those questions in the book that I recommend it there. So see you in the next video, and thanks for watching.